You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I will welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is founder and managing partner of DJE Texas Management Group, Devin Elder. Devin is a real estate entrepreneur based in San Antonio, Texas. He started his career renovating single-family properties and has since moved over into the multifamily space. Since 2012, he has completed over 100 real estate investment projects and currently owns 660 multifamily doors. And so the goal in today's show is to pull back the layers of Devin's business and take a look at the mechanics of how he's been able to build a significant multifamily business in only a few short years. In addition, we're going to dig deep into the capital raising side of his business to see how he's been able to fund his growth over these last few years, building up to that 660 door holding that he has. So I'm very excited to get on the show with Devin. But before we do, just want to run through a few important updates with you guys. You've heard me mentioning for the last couple of weeks, or actually the last month and a half now, that we are officially into the countdown stage of releasing our second mobile home park fund. We had some great success last year with our first open-ended fund for mobile home park investing. I know a lot of you got involved and partnered with us on that. And now we've closed that first fund out very successfully and are looking to launch the second one. Again, we're weeks away from it. We've already got 6 parks in contract, and we've got a ton more in the pipeline behind that. So we've got some big things happening this year, and we'd love for you guys to be a part of it. And I will tell you that my team and I, we really pride ourselves in our ability to uncover incredibly profitable mobile home parks, even in this incredibly competitive marketplace that we find ourselves in today. I mean, it's really hard to find deals out there. We do work with traditional brokers, which is kind of the common path a lot of people take, but that's not really our secret sauce. We've really spent many years, last 5 years, researching hundreds of markets throughout the U.S. and have built what we consider to be our proprietary database. It's like that is our secret sauce. So the proprietary database of mobile home park owners and operators throughout the country. We've got their cell phone numbers, their home mailing addresses, and all the other important contact info that we need to get a hold of them. You can't just go buy this list. And so we've built it over many of years. That allows us to go straight to the decision makers and negotiate much better deals than one might get before that property goes out into the open marketplace. Once it goes out into the open marketplace, nowadays, things get bid up by hundreds of thousands or even $1 million over asking price. And so we're able to essentially get those deals in a very roundabout way before they go to the open market. And so I'm telling you all this because we would love the opportunity of partnering with you on these future opportunities. And so if you'd like to learn more about that, more about partnership with our team, you can go to sunrisecapitalinvestors.com. You create a free account inside our investment portal. And this will essentially put you on the first to know basis for when that second fund rolls out. Again, we're just weeks away, and we're expecting our subscriptions to fill very quickly. Based on the demand we had for the first fund, they filled up fairly quickly. We had to turn millions of dollars away at the very end. And so if you'd like to get in, you'd like to team up with us, go to sunrisecapitalinvestors.com. And so that takes me to my second point. We're really good at finding deals, but there's never too many deals to have, right? And so if you're out there on the hunt and you're looking for opportunities, whether it be for mobile home parks or multifamily deals like Devin does or any other type of real estate, and you happen to stumble across or trip over what seems to be a decent mobile home park opportunity, I want you to think of us. We're interested in 60 spaces or larger, and we could take down deals as large as $25 million. So it doesn't have to be an individual park. It could be a portfolio. We'd love the opportunity to either pay you a big finder's fee or even potentially partner with you on the deal. So if you've got something that seems remotely interesting, shoot me an email directly. My personal email address is kevin@kevinbupp.com. Again, kevin@kevinbupp.com. And we've got a couple deals right now where we're paying big 6-figure referral fees on. So I'd love to be putting that money in your pocket. Lastly, guys, if you happen to be in the Tampa Bay area, to where I'm based out of, I mentioned this. I've been mentioning this for years now. I'd love to meet with you. So if you find yourself in the Tampa Bay area for work or pleasure, whatever it might be, I'd love the opportunity to have coffee or grab lunch with you. Just had a great meeting the other week with a gentleman from Northwest Ohio. It was awesome. And I probably have like 4 of these meetings a month. It's just a lot of fun. I get to meet others that share the same passions I do about real estate investing. So if you find yourself coming to the Tampa Bay area and you got some extra time, shoot me an email, kevin@kevinbupp.com. I'd love to hook up with you. So now, without further ado, let's get on to today's guest, which is Devin Elder. So Devin, how you doing today, my friend?
Kevin, doing awesome. Thanks for having me on. I appreciate it.
Yeah, I'm excited to dig into your story, man. So I want to start off by passing the mic back to you because I've got so many questions. But before we get into the meat and potatoes, what I'd really like you to do, Devin, is just take a step back. I gave you that like really abridged introduction there. So take a few minutes, step back, and tell us a little bit more about yourself and how you got into real estate in the first place.
Yeah, sure. I think I started in investing in single family houses, like I'm sure a lot of your listeners did. And I'll take it way back, and I won't spend too much time on it, but I was homeschooled as a child until 6th grade. So something in my early childhood had a big impact on me where I had this kind of freedom and autonomy growing up until I was about 11 years old that I think I've been searching for ever since when I started in school and college and even in the workplace. I think I've always been searching for freedom and autonomy. And so I would say as an entrepreneur, and like a lot of entrepreneurs, that's really kind of one of my highest values or things that I seek is freedom and autonomy. So I did go to college here in Texas, and I went into the corporate world. This is, after I met my wife and I'm getting, in my 20s are kind of creeping by, and I'm going, man, I need to get a decent job. And I think the corporate world's probably the way to do it. So I jumped in and started doing that. And it didn't take a whole lot of years before I really just got tired of the politics, the bureaucracy. And then I started asking myself this question. And I think questions are really, really super powerful. And I think most people ask very low quality questions. And the people that I associate with that are very successful tend to ask high quality questions. And so I started asking myself a high quality question in my corporate environment. How can I double my income, or how can I triple my income? Or could I 10x my income? And real quick, my brain starts providing me feedback that, well, my boss's boss maybe makes 3 times what I make. And that's like a 10-year just slugging it out, maybe stabbing some people in the back and climbing up that corporate ladder, and then living at work, sun up to sundown, and still being in the corporate world. And so that was just not a ladder that I wanted to climb. And so anyway, being driven by this desire to have more freedom in my life, and money is a piece of it, but really being in control of my destiny and having that entrepreneurial spirit, I started investing in single family houses. And I started with one little rental that was bought it for $38,000, and it needed, I think it needed 10 or 12,000 in rehab. And that was, to date, having done over 100 deals and all these different projects, that was one of the more scary projects I'd ever done. I was in hard money, and it was my first time out. That ended up being a great little cash flow project, and I was hooked. So once I'd figured out that strategy of buy with hard money, fix it up, and refinance out all your money, or maybe you've got 5 or 10K left in the deal, I had something that I could scale. And so for the next few years, I worked really hard scaling up a single family rental portfolio that would replace my corporate income. So that was kind of my foray into the real estate space.
Okay. So let's talk about that for a little bit. Let's talk about the single family side of your business. So essentially what you did, you would buy with hard money or private money, fix up, and then refinance out. But you were buying to hold, correct? So even back then you were really thinking of long-term cash flow, even though it was in the single family space, which is different where you're at today. It was always a long-term hold strategy. Is that correct?
Yeah, that is. And I had read Kiyosaki, Rich Dad, Poor Dad. I don't know if any of you guys have ever heard of that book, but it's a popular real estate book.
Just a little bit.
Yeah, obviously, Robert hammers on the cash flow very much in that book. And so I think that I read that book several years before getting into real estate. I think that had an impact on me. But my goal this whole time building the single family portfolio was get to X amount of dollars a month in passive income. It would that would meet or exceed my W-2 income. And that was when I was going to give myself the green light to go ahead and quit the corporate job. So I didn't want to be dependent on flipping a house or some big chunk of money that may or may not come in. I wanted that consistent cash flow. So I think it was a more conservative transition into full-time real estate investing. And I basically kind of promised myself that I would get the cash flow there to replace the corporate income and then go on and do.
Okay. Perfect. How long did it take you to get there?
About 2.5 years.
That's quick. And how many units was that? And do you mind sharing what kind of passive income that was generating at the time you decided to take the leap of faith?
Yeah. So it was, I ended up getting a small multifamily, and I was looking for, I think it was $5,000 or $6,000 a month in cash flow. And so I had a small multifamily, and then I had a bunch of single family projects. It was probably like low 20s in the units,
Okay.
22 units, something like that.
Okay, got it. And where were you buying at that point in time? What market? Are you staying in Texas at that time?
Yeah, this was all in San Antonio, Texas. I'm from here. I live here now, and I honestly have never ventured outside this market. I haven't found the need to yet.
Got it. Okay. I want to talk about the transition from single family to multifamily, and like when that light bulb went off. I mean, you kind of slowly did it with that smaller multifamily, but I know that you've been buying some larger stuff today. But before we go into that discussion, I want to learn a little bit more about your foundation, which is the single family side of the business, and really learn more so from the learning stages. I mean, did you kind of go through the school of hard knocks to learn this process and that system that you put in place? Or did you hire a coach? Did you hire a mentor? Did you have some buddies that were really successful that you kind of leaned on their shoulders? Talk to me about that process. I feel like a lot of people, they go one direction or the other. Either they immediately dive into like the coaching space, they hire a coach through one of these different companies or an individual, and then they go through that route for a period of time before they dive out on their own. Or then there's the others that are kind of the bullheaded type that just like, you know what, I'm going to dive in, I'm going to fail. Right. Fail forward fast, and that's how I'm going to learn, right? School of hard knocks. So talk to me a little bit about your process that you went through.
Yeah, I hired a mentor right out of the gate. And I give that process massive credit, and it's a process that I've used again and again in lots of different areas of my life. And I think the key to success in anything is so simple, but a lot of people don't do it. The key to success in anything is finding somebody that's actually achieved the result, not on their way to it or studying it or knows about it, that have the result, and copy them exactly. And if you need to pay them $1,000 or you need to pay them $20,000, whatever, if you're going for a big result, the coach might cost you a lot, but they have to have done it. And so I paid a decent amount of money for a coaching program right out of the gate. And I got to say, it set me off on the right track. So, and I'm still an advocate of that. I'm a part of mastermind groups. I hire coaches. I mean, and you keep going up and meeting, higher net worth people, and they're also in masterminds, and they have coaches, and just a never ending process of surrounding yourself with the right people. So I credit I would say it's a relatively rapid growth of my portfolio over the years. I credit it to just being around the right folks.
I've always been so confused at how adverse people are that are getting started to paying money for coaching. Like sometimes I might jump on Bigger Pockets and I see entire like threads and forums of people discussing like, you don't have, should I pay this amount? And like, there's so many people, no, don't pay for it. Don't pay for any kind of coaching. You can learn a lot here, this, that, and the other. And I somewhat disagree with that. I mean, you can learn on your own. There's lots of free resources out there where you can get a lot of great information. Podcasts. I mean, gosh, I wish podcasts existed 20 years ago. They did. You know what I mean? I mean, just podcasts alone, but then you got Bigger Pockets, which is awesome. But at the end of the day, if you really want to accelerate your growth, is to find someone that's doing it. Find the real deal. Find someone that's not just been there, done that, but's doing it today. It has a proven formula that's working today, not that worked 10 years ago. And and lean on their shoulder, right? I mean, follow their direct path. Why reinvent the wheel? So anyway, I don't want to beat a dead horse with that, but I've always found that quite interesting, those folks that are so adverse to actually paying money when they probably spent $30,000, $50,000, $100,000 on the formal education, right? But they're so adverse to $3,000 on getting some coaching that would probably, accelerate their growth very quickly and also get them to, leaps and bounds ahead of where they are with that formal education. But neither here nor there. I want to talk about the light bulb moment that went off, when that happened, when you really decided to make the switch from single family to multifamily? I know you said part of that initial portfolio that helped you leave your corporate job, part of that was a small apartment complex. Don't know the size, how many units, but at some point in time, you graduated to a much larger scale. And so talk to me about that moment.
Yeah, it was always in my plan. So I did have a light bulb moment in my corporate career when I decided I was going to make real estate work, and this was going to be it. It was very early on building my portfolio, but part of that coaching group that I was a part of also had some folks that were doing multifamily, and they were doing well with it. I just wasn't, in my mind, I wasn't in a capital or life experience position to go raise millions of dollars from people. I knew people did it. I've been studying it for years, but I personally didn't feel comfortable. Really, it was until I'd done that. There was a little 6-unit that I bought, and I did everything, right? I managed it myself. I completely ran, it was all my money in that project. I didn't have any partners, and I really just needed to prove that to myself. Now, I'll sound like a bit of a hypocrite. I'll go tell people, just skip to 100-unit plus multifamily. Don't mess with all the other stuff. And people are like, what are you talking about? And I'm like, trust me, I'm going to save you years of heartache. And people just can't make the mental connection. And I couldn't either back then.
Me either. I get it.
I just couldn't do it. So, but after doing that little 6-unit, I thought, okay, this is obviously it's barely multifamily, but it's multifamily. I'm doing it now. And also another thing that gave me the confidence was I did my first probably 10 single family deals with hard money. But after that, I had a track record. And at one of these meetings or whatever, I ran into somebody that was, said, hey, you're doing well. I can loan you this money at a little better rate than you're getting. And that was a big aha moment for me, borrowing private capital. Mm-hmm. And so I started to borrow private capital, and over the next couple of years, borrowed millions and millions of dollars for these projects. And so by the time when it came time to raise $1 million for multifamily syndication, it was just a little leap in my mind to go, well, I've already raised millions of dollars, and I've returned it all to these investors. A lot of them are the same investors. I'm rinsing and repeating. So I trust myself with millions of dollars of other people's money at this point. That is not a small thing. That is not something to just jump into. And so, again, it's just part of my kind of natural progression as an investor. It was okay. I'm ready. I'm okay to go raise $1 million because I've done it before. It's just been across a bunch of projects, and really, one multifamily project that's underwritten correctly and that you budget correctly for, can be, or in some ways is less risky than kind of all these single family houses or flips or whatever. So that was it's been a natural progression, and raising millions of dollars of private capital for flips and single family stuff really kind of gave me that mental, I gave myself permission.
Sure.
Okay, I've proven myself, and I've made a bunch of investors money. I'm ready to step up to the next kind of level here.
Yeah. No, there's nothing wrong with starting small. You're right. The advice I give, the same kind of advice you give, like, bypass all the small stuff, go into the bigger stuff. The bigger, the better, easier to finance. And, it's just, I couldn't wrap my mind around it many, many years ago, same as you. And so it's easier said than done. But I will tell you, like, some of the benefits of doing smaller, if you have the personal capacity to use some of your own money and risk some of your own capital, even if you're going to get some hard money involved or a private lender, if you start with smaller stuff, you could still prove the concept. And so if your intent is to buy 100-unit apartment buildings, you can surely prove that concept. Like, you're going to be a value add investor, right? You're going to buy things that either have operational challenges or need renovations. So you're going to go through and renovate interior of the entire apartment complex. You could do the same thing on an 8-unit property. The same model applies on a much smaller scale. And so I've always told people is that, if you don't have a broad network of investors that you can go, tag into, like, your family or friends, whatever, that's going to, be able to raise $10 million out. You don't have that network built already. Starting small, proving that concept, risking some of your own capital and building off of that plan, and then taking that, that proven concept out to the investment groups and the other guys, the network that you really haven't built yet. Take it out to those folks and say, here's what I've done, and here's what I intend to do. Now it's just on a much bigger scale. I feel like it's a lot easier to raise capital when you've actually got a little bit of a proven concept. And again, you can start with 100 units, just sometimes, easier said than done. I want to talk to you about you're in the multifamily space, but what part of the multifamily space you're in? Like, do you consider yourself a value add investor? Do you look for heavily distressed deals? Give me an idea of what you've done in the space in the larger complexes. And then is that the same place you're at today? Is that the same things that you're looking for?
Yeah, I think I'm always fine tuning kind of my role, what I'm good at, what I enjoy, where I bring the most value, and what kind of asset's going to make sense. So there's a 75 unit that I own that was just an incredibly deep value add. I mean, literally had to take the property down to zero, just about zero occupancy, and touch every unit.
Wow.
And, down to the sheetrock. And so that's been a good project. But when I look at kind of the ROI on how difficult it's been, now the return to investors and everything, great. But when I look at how scalable it is for me personally to keep on doing this, that's probably not something I'm going to go do 10 more of. My kind of sweet spot is B and C, 1970, 1990, 100 units plus, So obviously a lot of syndicators, a lot of multifamily guys, that's
what they're looking for.
Right? I mean, that's what everybody's looking for.
Yeah.
So no surprise there, but it's a balancing act between, finding some kind of a value add component or rents below market or non-renovated units or some operational challenges that are easy to overcome. There's a property I closed about 6 weeks ago. It's 130 units where, everybody's none of the tenants were paying any of the utilities, right? And so that's kind of an opportunity to go evaluate it and see, well, will the market support if I renovate a unit? Can I push those utilities back on the tenants? And that's going to represent a lot of value. So there's got to be some kind of a value add component there. B and C stuff, 100 units plus, 1970 to 1990 is just kind of where I'm looking. I think my goal is just to keep improving my systems and my company to the point where I can build something that obviously the entire thing's investor return driven. So if I can just build a model that we can continue to source quality, conservatively underwritten investments and keep doing a couple of those a year and just keep building them up, then that's the model. And I suspect, barring some sort of macroeconomic upheaval, that that'll be the model that I continue to pursue. Now, as we all know, it's gotten tighter and deals are harder to find and all that fun stuff, but that's just the nature of the market cycle.
Yeah, absolutely. I want to talk to you about finding deals, how you guys are finding deals. Before we do that, I want to hit on something that you mentioned about that 130 unit that you just closed on 6 weeks ago. One of the but probably many value add components on that deal were the potential to sub-meter back or for bill back for utility usage. I'm assuming you probably implemented the RUB system there. I want to talk to you about how you made the determination that the market could or could not support you implementing a RUB system and basically passing that cost back onto the residents. Because that's something that I think a lot of new investors, they might get some basic training and they just assume that could be done all the time. But really the market determines that. I mean, yes, technically you could always implement a RUB system, right? But sometimes it's not the norm in that marketplace. Right. There's a lot of markets where you're going to find that like that. The common practice is including utilities in the total overall rent. Whereas in some other markets, you'll find that is not the norm, where the norm is billing back for everything. You might find that needle in the haystack where they have not billed back for utility usage, which you can take that savings and drop it directly to the bottom line because you can bill it all back 100%. And so talk to me a little bit about how you made that determination in the marketplace and identified this then as an opportunity because of that.
Yeah, this particular property is a mid-70s vintage. It's masonry and it's in solid shape, but just looking at the property, you could tell that the current ownership had not really earmarked much for capital improvements, or they'd run out of money or whatever. And they were just it was family operated, good guys. They had not run into the ground or anything, but just taking a look at their financials, it was kind of obvious that things were a little bit of a mess and it kind of had been mom and popped. So this property sits in a working class area. It's a C building, C area, but not too far in the immediate submarket, there are some nicer properties. And so really, I rely on a lot of different team members, whether that's attorneys or property management or mentors. And, always, I'm always learning and leaning on people. But what made the determination for me was just going through the due diligence process with the property management company that was going to take over and operate the property. And I actually have them doing construction management on the property too. So, I've kind of got one vendor here handling a lot of stuff on this property, but it was going through and making the determination of, okay, currently the property is shouldering what amounted to over $200,000 a year in utilities. Can we go and do a reasonable renovation, clean and functional, not over the top? This is still a C property. I'm not trying to turn it into Ritz-Carlton here. This is just making it clean and functional. Can we go in and do a nice renovation and bump the rent maybe $25, $45, but also get the utilities? And that was really my primary question after the tour and during due diligence with the property management company. Can we pull this off? And so the short answer would be that I rely on a property management company, where the owner's got 20 years experience doing this to tell me and validate my own assumptions, because I don't want to trust my own assumptions. I want to bounce my assumptions off the management company that's going to be running it. I want to bounce it off other syndicators. I want to bounce it off, people that have been on this road longer than I have. And once, you kind of get a series of data points validating your assumptions on something like being able to build back utilities, then I can feel confident building that into a pro forma.
So as part of your pro forma, actually doing both those at one time. So like on the same fail swoop, you're going to raise rents. So you're going to renovate the unit. So you're going to do a turnover in that scenario. You're going to be able to bump rents and build back. Do you feel like you're going to be able to accomplish both those all at the same time, or will it
we are
progression?
No, we are. So the first 2 units that we renovated, I told the property management company, hey, just offer it to everybody that lives here, as long as they qualify. I mean, they're gonna have to re-qualify, but if they qualify, offer them the new unit. That way, we get a tenant without any marketing. Yeah, and they move in, and we get another unit to renovate. So we've had 2 move-ins so far at the new rate, which is a $25 bump in rent. It's not huge, but the real bump is now that we're not shouldering any of the utilities. So the goal is over the next year, 18 months to go through, and as we turn units, ideally we move existing tenants over to a renovated apartment with a slight rent bump and the utilities, which we've proven so far on 2 of the units, and then just continue to do that over the next 12, 18 months.
What did the average utility usage equate to per unit?
Well, shoot, it was.
I know it varies based on occupancy and things like that.
I think it was 200 and let's call it 210K. And
so do the quick math. Can't do that in my head.
This is a weird property. It was actually 106 units, but 24 of those units were 1-bedrooms stacked on top of each other with a spiral staircase. So I'm walking through it going, well, we just turned these back. We're going to add 24 units to this property, and it's going to change the unit mix. So now we have a bunch of we're going to have a bunch of 1-bedrooms. Yeah. But those 3-bedrooms were crummy, and spiral staircases. To me, that's dangerous. That's a liability. So I'm actually adding units to the property, but at the total utility bill, divided by 106 units, we're looking at like $150, $160 a month that we're able to just take off of the property. So between adding units and shifting the utilities, there's a value add component there that I was pretty excited about.
Yeah, the beautiful part about that is once everyone has to start paying for their own usage as well, people tend to conserve a little bit more.
Yeah, that's right. Absolutely.
They don't wash their cars 5 times a week, or you don't let the bathtub run or the shower run for like an hour and a half at a time, or let all their friends come over and take showers at their house. That doesn't happen anymore. Like that. I've found that on average, when we build back, when we actually put meters, it's like in our mobile home parks, we'll go in and sub-meter the water and bill back accordingly. We've had reductions as high as like 60%. I mean, incredible. Significant amount. I mean, because again, once you have to start paying, they start becoming a little bit more responsible. So, you're doing a great duty to the environment and to your bottom line. So it's a beautiful thing.
Absolutely.
So I want to talk to you about what excites you about the market we're in today. And so, I want to take it from the standpoint of deals are hard to find. Everyone out there is searching for opportunities. You guys have been able to cover them, but what excites you about the market that we're in? Because having difficulty finding good deals is not exciting, right? It's more exciting when there's like lots of opportunity out there. So what is it that excites you about the multifamily space today and the market that you're investing in?
Yeah, great points. So I get excited about demographic trends, in my market, but really kind of at the macro, I guess what you call U.S. level too. I mean, you've got this historic shift away from home ownership. You've got millennials being maybe more biased to renting. So I think you've got an interest in renting that's maybe unprecedented in the last, who knows how long. So I get excited about that. I get excited about the positive net migration to San Antonio. So my market specifically, we've got a very diverse employment base, right? We've got military, we've got medical, we've got a tech scene that is by no means on par with, say, Austin to the north of us, but it is trending upward. And you've got just positive net migration and folks come into the city because it's still fairly affordable to live here. And then we're starting to get there in terms of exciting things to do downtown and, restaurants that get, national acclaim and things like that. So San Antonio, it has long been this slow and steady market. And I think it'll continue to be. I mean, it's maybe picking up a little bit, but, I don't anticipate that we're going to see some massive growth and then have it implode 2 years later. I hope that for the future of San Antonio, we can just continue to have a nice, slow and steady rise. And with that comes increased demand for, B and C class, 1980s vintage stuff that you just can't build anymore. Because if you're going to build Class A, you're going to go ahead and do the top of the line finish outs because it doesn't cost that much more to do granite or backsplash or whatever. And you're going to go try to command a rent premium. Nobody's building affordable housing. I don't mean affordable housing by government subsidized. I mean affordable housing by just your average working class person being able to get a clean, functional place to live. That inventory is really tight. So as an owner operator, I like to be in a position where I'm providing a product that's in high demand, obviously, but all those things are trending in the right direction.
Yep. No, I agree with you. And so the population of San Antonio, what is it, about 1 million in the MSA? Is it bigger, smaller?
Yeah, we're probably closer to 2.
Are you really? Okay.
Actually, you know what? I think it was 1.5 and change the last time I looked. So it's kind of right in the middle.
Got it. So you're focused on San Antonio today. Is there opportunity left there for you in your niche and what you're looking for, being that there's lots of other people looking at that same marketplace? Is there still opportunity left? And if so, how are you finding it? How are you finding those communities that meet your criteria?
Well, I think there is, I make the parallel to the single family business that I started in, and people started complaining a few years ago about how hard it is to find deals. And it absolutely is. But, I still have a single family house company, and we do a ton of deals. I've got a great team running that, and the guys work really hard, and we've got really good systems, and we find a ton of deals. So is it hard? Sure, it is. But we've built systems to kind of overcome that. So I'm in the process now, we're talking in Q2 of 2018 right now. We're in the process of building the same kind of outbound marketing engine for multifamily projects. So we try and source some more off-market stuff. And I think what will help my company there is now we've got a track record, and we can say, hey, look, we're interested in buying your 150 unit property. Maybe it's not this year, maybe it's next year, but you're getting a piece of mail or a letter from us forever, pretty much, because
that's what we do.
If you're targeting 1,000 properties, you can pretty much mail them all the time. And so there's going to be some of that mind share. And then for the ability for me to come and say, look, we own a property 3 miles up the road, and we're local, we're from here, we're well capitalized. Now I'm syndicating, so I'm not going to go out and buy these things cash, but we can close them for sure. And so that's kind of what I'm in the process of building out, that model. There's also broker relationships, right? So, broker sells you a deal, you perform on it, you don't give them a ton of headaches, and you perform as a good buyer. That's the same thing I did as a single family buyer. It's like, look, we're going to close, we're going to get it done. We're not going to jerk people around. And so you develop that relationship with the brokers too. And so that's really kind of my goal is broker relationships, and then ramping up some outbound marketing the way we've been able to do in the single family space.
Yeah, no, that's fantastic. I mean, that's, again, same in our space. It's really crowded, and if we just relied on what brokers brought us, and we wouldn't be buying much at all. But the interesting thing that happened, I was just recently a couple of weeks ago at our industry conference out in Vegas, and all the big brokerages are there that represent the MH space. And I know majority of them, not all of them, but I know majority of them. So I kind of go around, get some FaceTime, and a lot of them are talking about deals, or they might have some flyers out with opportunities, or they might be mentioning a few that are kind of coming into their pipeline that are, kind of off market per them. And
Right.
I knew a majority of the deals, which is funny. I'm like, oh yeah, I've talked to that owner like 3 years ago. I talked to that guy like last month or whatever. And and they're like, what do you mean? I'm like, yeah, I was like, a lot of your clients probably get mail from me on a regular basis, and some of them take offense to that. I'm like, some of them don't know that we do that. I mean, like, we essentially we're not trying to circumvent the brokerage system. It's just, I know once they get a hold of it, if they're the type of broker that's going to truly take it out to the market, because that's really in their client's best interest, right? Like, the goal of the broker, if they're going to take a listing, is to get the highest and best number for it. And I understand that. So it's really hard to be a buyer. Now, those same brokers, I surely will give them our property to sell, right?
Sure.
But for buying, I want to kind of control my own destiny. And we do that by just like what you're going to do. I mean, we go direct, and brokers play a great role. And there's definitely some deals out there that having the broker involved, the broker act as the intermediary, and they helped control the pricing of the deal a little bit, where the seller had some crazy expectations.
Sure.
Obviously, our opinion is a little biased because we want the best deal. The broker helped kind of smooth it out and actually got us a better deal than what we probably would have gotten by going directly to the seller. So in any event, I'm excited to hear that you're actually going to be proactive about that and start marketing directly. So I think there's a lot of opportunity there. And that really goes out to everyone that's listening right now. I mean, it doesn't matter if you're in the single family space, multifamily, or mobile home park, or any other niche. If you're buying shopping centers or office buildings, you can definitely utilize that direct to owner strategy that Devin and I are talking about. I mean, I wouldn't say it works on the institutional level, but sure as heck works really well with the smaller mom and pop, or, smaller professional operators. So in any event, I want to talk about what the next 5 years look like for you, Devin. I mean, what are kind of your goals as far as the growth of your multifamily side of your business, and how are you going to get there?
Yeah, that's a great point. I think I have kind of 5 years is my horizon to really hammer it hard. And when I started in the single family business, I kind of mentally gave myself a 5-year horizon that I thought about it like bartending, or maybe playing in the NFL, right? Like, really good money, but don't do it for very long, right? Don't plan on doing that for very long. And that was kind of the single family space. Now, I've been able to continue the single family business because I have a fantastic team, which I kind of lucked into, and it's, it's a great business. There's no reason to kill it off. I still have lots of private lenders funding these deals. So that's a great business, but I've been able to step out of it and focus on the multifamily. So now my goal is to go out and acquire every multifamily deal that makes sense, 100 units plus in my market, preferably, and close on 2 or 3 of those deals a year for the next 3-4 years. But really, the multifamily space is so exciting for me because there's so many opportunities. I mean, there's a deal that I'm a key principal on that I'm not the asset manager on. So I've got equity in a deal that doesn't require a lot of my time. And I'm going, well, that's a great kind of strategy where I can start investing in other sponsors' deals, maybe using my network to raise a little capital for those deals, maybe being a key principal and putting up my balance sheet on a deal that's got some nice, Fannie or Freddie non-recourse debt on it. And so I think I can really build a meaningful, substantial portfolio that I'm the asset manager and sponsor on for the next 5 years, and then start to kind of taper off. And through the relationships I have, say, okay, the next guy coming up, let me KP your deal, and I'll get a little piece of it. Let me invest $100K in your deal, and I just want the checks. I don't want any operational headaches. So I plan to just kind of shift. I love chasing deals. I love doing deals. I love putting stuff together. I love challenges. But I'm turning 40 this year, and I think from 40 to 45, I hit it hard on the acquisition, and then start to kind of branch out and do some more passive stuff. That's the game plan anyway.
Got it. Let's talk about it. I'm glad you brought up the key principal thing. Talk to me a little bit about what that means for those that are listening in that don't know what a key principal is, and what kind of role that plays in your mind, like in some of these deals that you're not the asset manager on. So just define that a little bit for us.
Yeah, so I'll talk specifically about let's say a 100-unit multifamily project that is 90% occupied or 92% occupied. So if you've got something like that, and it's what is called a stabilized property in the industry, where it's got 90% plus occupancy for the last 3 months or more. Well, that property could potentially qualify for some very attractive finance, non-recourse financing, where essentially, if essentially the bank can't come after you personally, they can take back the property, but they can't come after you personally. And it's the reason why multifamily sponsors and operators can have tens or $100 million worth of debt and be able to sleep at night. And another really attractive thing about being in the multifamily space. So what a lender wants to see, just speaking in general terms, if it's let's say it's a $4 million loan on a $5 million property, just for easy numbers, the lender's probably going to want to see the balance sheet of the guarantors equal to that $4 million. And they're probably going to want to see liquidity of, 10% of that, or sometimes 9 or 12 months of principal and interest on that last 130 unit they wanted to see. It was like 200K of liquidity. It wasn't a huge number, but they wanted to see the full 4 point whatever million dollar loan balance that the key principals had that. So, in that case, for that last deal, it was me and I brought on one other partner, and we got our balance sheet where it needed to be. But in a nutshell, you can basically put your balance sheet up on a deal like this. Obviously, it's got to be a good deal. You've got to have a great relationship with the sponsor, all that good stuff. But you can put your balance sheet up on a deal, and especially attractive if it's non-recourse, because there's some additional protections there.
Yeah.
And the bank's just going to want to see that, okay, there are the principals in this deal have the financial wherewithal to take something like this on. And so you're either putting up your balance sheet or your liquidity or both, and you're getting a piece of equity in the deal. And that could be substantial for what essentially amounts to just signing on the note, and you don't really have any responsibility after that.
What's the norm as far as what kind of equity one might expect if they're going to put up their balance sheet and sign on as the KP of the deal?
I would say 1% to 3% is what I've seen.
Got it. Of the GP share, or
I've seen as high as 10% of the GP share.
Okay.
So usually I do a 70-30 split, where limited partners getting 70, the general partner's got 30%, and then out of that 30% pie, 10% of that could be carved out
for the KP.
For the KP. So that equates to 3% of the deal. On the high end, I've seen lower. But so you got 3% of the whole deal, or 10% of the general partner, just for being a KP. Then the bank's probably going to want to see the KP invest some money. That's going to be case by case. But that's a great opportunity, and something that I want to, as I grow my net worth, to be able to leverage my net worth moving forward and say, hey, we got some new operators or guys maybe a little earlier in their career that I believe in, and we've got good deals, and I can participate in them.
Yep.
And get equity by really just signing and investing in it, which I'm probably going to invest in the deal anyway. So I think it's a good opportunity, something I want to explore moving forward to leverage that balance sheet.
Yeah, no, that's a great idea. I mean, it works towards your goal also of being in 5 years from now, being involved as the KP and sponsor of like your own deals, right? Asset manager of your own deals, but also start leveraging more towards that more passive role as time goes on after that 5-year horizon hits. So what is the goal after that 5-year horizon? I mean, with the deals that you're involved in, I mean, if it's Fannie or Freddie type debt, then you're kind of in it for the long haul. I know Fannie's assumable. I'm assuming Freddie probably is as well. But is your goal to exit out of these things? Is it really like a 3 to 5 year horizon to either exit out, or are you guys looking to hold on for the long term?
It's usually it's a 5-year underwritten to a 5-year hold.
Okay.
So
with the idea that you'll actually put it out and put it up for assumption.
Put it up for assumption. So I want debt that's longer than that. If I can get 10-year fixed, especially now. I mean, the last deal I closed was 4.8 something interest rate, and in 18 months that might look like a pretty darn good interest rate.
Yeah, right.
If it's locked in at 10 years. So I like to see debt out 7-10 years and underwrite to 5 years. Obviously nobody's got a crystal ball, but I try to underwrite with a really conservative exit cap rate and plan on selling in 5. Now if we get the property turned around and somebody's banging on our door in 2 years and we can hit our targets, certainly something to consider. The problem is then what? You make everybody whole, you make everybody a bunch of money. Well, then where do you put it if you can't find another deal? So it's a balancing act.
Get your
on
direct
that.
mail campaign going. That's what.
Yeah, that's right. Get some fresh deals going. I'm telling you. So
Deal flow. That's it. That's it. It's funny. It's when you first get into the business, with any part of the real estate business, you're thinking, how am I ever going to come up with them? You never think about how am I going to find a deal. You think about how am I going to get the capital? How would I ever get the capital to do these big deals? And then there comes a point in time you're like, I got the capital and I got deals. I just don't have enough deals. I need more deals. Like it switches at some point in time. It's quite interesting to see the dynamic there.
Yeah, no doubt. And then you've got investors, wanting to get in deals too. And you're going, geez, for years, I just did everything I could to try to raise money and get money for these deals. And now it's like, it's going up the seesaw and it's tipped. And now you're going, I got to place a lot of capital here, to kind of keep everybody happy. And it's a very interesting phenomenon that seems to happen there.
It's a good problem to have, right?
Absolutely. That's, we complain about, taxes if you got a big sale and you're getting hammered on taxes, but it's like, well, that's a good problem to have.
Absolutely.
Where do I invest all this money? Good problems.
Yep. So I want to talk to you a little bit about mistakes, and I'm a firm believer that if we're not failing or not making mistakes on a regular basis, we're not growing as individuals. We're not growing in our business, right? I mean, we learn from our mistakes. The whole idea is that you actually take a lesson from the mistake and don't make that same mistake again, right? And grow from it. Talk to me about a challenging time or a challenge that you faced within your business over the last 6 years that you've been in business, whether it be single family or multifamily space. A big challenge that you face, and it could be maybe a challenging partnership, maybe a lawsuit, anything of that nature. Something that you felt was a great struggle at that point in time that you became a better person or a better investor because of it.
Yeah, I definitely faced some struggles early on. I started out with rental houses, which kind of right out of the gate, I had that system dialed in and they did very well for me. And I like rentals because I feel like it's a conservative investment approach. But after I'd done quite a few of those, I started getting into flipping houses, which I believe is a very, I don't know if risky is the right word, but it's definitely more unpredictable. And so there was a couple of flip houses where I just, went bit off more than I could chew. Bigger project. I was excited that I could be doing this, period. And I was going to go do this big project. There was one particular, in a historic district. It was adding square footage. And it was one of these deals where kind of everything went wrong. It was
hairy deal.
Dealing stuff with the city. I had a bad contractor. We had bid the thing wrong. And I ended up having to scrape together, a lot of capital to get this thing over the hump. And it did, but at the end of the day, it did not make money. It didn't ruin me or anything, but it was a lot of work to lose some money. And that was kind of, I think that deal was kind of my growing up in the real estate space. And it was a real punch in the face. And I'm, looking back on it, losing the money is not that big a deal. One thing I do pride myself on is that I've lost money on a couple of flip deals, never on rentals or multifamily, but I've never lost the investor capital. I've never had a situation where, somebody loaned me $200,000 and I was late on a payment or I didn't get it back. So I've never, ever had that happen. And that's kind of my number one thing, right? Somebody gives me money. I'm a steward of it. And that's the main thing.
Yep.
But so I've gotten kicked in the teeth a few times on a couple of flips. And, it was just not budgeting correctly or getting the wrong team in there. And now I'm able to have a single family business because I have an awesome partner that manages the construction, and they do a great job on it. So we're kind of cranking through these flips. In the multifamily world, there's kind of something I'm going through right now. One of my properties is self-managed, and the rest are not. The rest are third-party management. And in my future, I absolutely see third-party management as the way I want to go, because I just the ROI for me, being the management company and dealing with, not that anything's hard, it's just a lot of minutia.
Yeah.
My best value is finding the deal that pencils and raising the capital and being the asset manager.
Yep.
And the more I can focus on just those three things, the more value I deliver to everybody. And so fooling around being the management company, it does not even pencil in terms of ROI. So that's kind of a challenge that I've had. And, not an overwhelming thing, just looking at the business and how to I'm always optimizing things, going, this is not optimal to if I'm going to be an operator, sponsor of 1,000 units or 2,000 units, it's just not going to fly. It's got to be third party management.
Yeah. Which is one of the beautiful things about your space that doesn't necessarily exist all that much in our space. I mean, that really, it's funny. You hit the nail on the head with what our bottleneck has been over the past year. I mean, we literally could be 3 times the size of what we are today. But unfortunately, we don't have the luxury of handing off our assets to a competent, we don't have a broad selection of competent third-party management companies in our space. Sure. There are a select few. Most of them are very geographically limited of where they'll actually manage. And for the most part, a lot of them are all that great. And it's unfortunate because we essentially have to build a vertical management infrastructure, which is its own business, its own headaches. It's not fun, simultaneously while we do what you just mentioned, which is underwrite deals, raise capital, and, take down these, take down the deals and actually acquire them. That's its own business as well. And I really wish. So you guys have some blessings on your side in the multifamily space, because I would love the luxury of just buying until the chickens come home, right?
That's right.
that would be my ideal scenario, but unfortunately, we don't have that luxury at this point. But we've built a pretty robust management infrastructure now, and but again, we could be a little bit further ahead than what we are. But now we're getting there. We're ramping up this year, and it's going to be a big year. We're going to double in size, and hopefully, thereafter we'll keep doubling every year thereafter. That's kind of the goal. And again, got to get the direct mail and the cold call stuff going, man. That's how you're going to do that in your space as well. That's how you're going to beat up the competition. Seriously. I
think it's going to be good. Yeah, we've just invested in a commercial printer, which wasn't cheap, but we did it for the single family business, and we'll send out 10,000 pieces a month. Mm-hmm. But I'm going, well, if I've got 1,000 multifamily properties in my market, we can hit them every quarter, every month for nothing, because we're printing ourselves. So we'll see. Time will tell, but it's one of those things that we've done in the single family space, and we've got a track record. We're a credible buyer of the multifamily space, so why not?
I got some ideas for you. We can talk after the show. I got some good ideas for you.
Excellent.
So I want to talk to you now about going back in time, and you've been doing this 6 years now, and you've learned a lot. You've grown a lot. You've done a lot of deals. If you could go back to year one and knowing what you know today, give yourself some advice. Like, Devin, you need to be doing this, that, and the other. Put your focus here. What would you tell Devin 6 years ago?
Yeah, that's a great point. It's easy to say, hey, just skip all the single family, go straight to multifamily stuff. I just, I would, this is kind of a cop-out answer, but I would almost say nothing. I mean, I started with the dream of replacing a 6-figure corporate job. And man, I got my butt handed to me countless times on countless things, right? Just learning the business. But I always thought that was really just kind of creating the kind of character and turning me into the kind of person I needed to be to go do these bigger things. And I think without those character building experiences, I don't think I'd be where I'm at. So there's things that I would go back and change, but that were painful, but those were also really character building experiences, and some partnerships have come out of those experiences too, that, it's been a crazy ride, but it's, again, those challenges have been very character building. And it's so easy to say from my vantage point now, when I was going through those things, I would have done anything to get out of it. But it's such a cliche. Those things build character. Yeah. And I think that serves me very well now, because I feel like my intuition has been, and my sense about these things has been sharpened over the course of just dozens and dozens of deals. And I don't know that you get that any other way than just going through it.
No, I agree with you, man. Well put. Well, now, Devin, we are going to enter what I like to call the golden nugget segment of the show. And I mean, you've shared a ton of golden nuggets thus far, but if you had one last golden nugget of advice or wisdom that you could leave with our listeners today that may motivate or inspire them as they progress in their real estate investing career, what would that one last golden nugget be?
Well, this is just more general and not specific to real estate, but something that really started to resonate with me a number of years ago, I think as I, got into my 30s, was there's no someday. This is it, man. Like, I'm not 18 anymore, dreaming about someday it's going to be that. This is it, man. So look around. What do I drive? Where do I live? Who are my friends? This is it. And part of that was like not good at the time. A few years ago, it's like, man, this is not a good someday. This is not how I wanted to end up. And so just being ruthless about pursuing the dream life that you want. And that sounds so cliche, but you have to be ruthless about who you spend time with, what kind of media you consume, what your goals are, because everybody's vying for your attention and you're just going to become like your peer group. So I've been just maniacal about getting in the right peer groups, cutting off any kind of information or news that it's not helping me grow.
Mm-hmm.
And I really do live a dream life now that it isn't an accident, right? So I would say the takeaway is that there's no someday. This is it. If you're an adult, this is your life. So
I love that. I think I'm going to put on my wall the ruthless pursuit of the life you want. I love that. Yeah. That's good stuff, man. Ruthless is a really good word too. very aggressive.
Sometimes it is. Yep.
Yeah.
Sometimes it is.
Well, good deal, man. Well, Devin, this has been a lot of fun, man. Seriously, I really appreciate you coming on the show, and got a lot of good information that we shared here in the past hour. I hope everyone that's listening in, took a bunch of notes. If not, go back and listen again, because Devin, what you've been able to accomplish in the last 6 years is just absolutely incredible. It really is. Normally it takes people a few years to even get their footing. Just to figure out, I got a deal here, deal there, and they kind of make some mistakes, and it takes them a while to figure out what they're going to do, like what the next 5 or 10 years are going to look like. And you're just like knocked down the walls and made shit happen. So congrats to you, my friend. You're just kicking butt. So for those of you that want to learn more about Devin and his company, you can go up to his website. You can learn more about I saw on your website, Devin, you got some of the deals that you're actually working on. You got some listings of your portfolio. His website is djetexas.com. That's D as in dog, J as in what? Jogging? I don't know. and sure. E as in Evan, Texas.com. Yeah, djetexas.com. Yeah, what would you use for J? What's the word that you should?
Well, I always say
what's
Dylan,
the military?
The military, I've been meaning to look that up. DJE is actually my kids' names or kids' initials. It's actually not my initials. So I usually just say that. Jay, I got to look up the military thing.
Yeah.
That sounds cooler.
Jogging. Where I came up with that, but good deal. Devin, it's been an absolute pleasure, my friend. You take care, and best wishes to you here in the future, okay?
Awesome. Thanks, Kevin. Appreciate it.